Welcome to MaxValue, a show for business owners and their professional advisors pursuing maximum value. We talk about business valuation, exit planning, global staffing, and all sorts of fun stuff. I'm your host, Ben Town. Today, Garry Whitfield comes back on the show for an immediate update to an episode we just put out on qualified small business stock because it has been changed with the, quote, big, beautiful bill that just got signed over Independence Day holiday. Normally, we don't chase the news cycle, even with events that are so important as this exclusion of large amounts of capital gains taxes for business owners. But we also couldn't let Garry's good work go so stale so fast. So Garry, welcome. Welcome back.
Thank you, Ben.
Garry, in a nutshell, let's just dive right in. What has changed in these new modifications to the Section 1202 of the Internal Revenue Code that we lovingly call QSBS?
Right. Well, actually, I look at it as there's been an enhancement or a bolt-on of really three things. So you'll recall the prior law, there was a exclusion cap, which is basically the greater of $10 million or 10 times the basis, right? Whichever is higher, right? Mm-hmm. And that was for stock issued after September 27th, 2010. If you held it for 5 years and a day, you had 100% exclusion. And that capital gain exclusion could be either 10 million or 10 times your basis in the stock. Now, the new law is for QSBS acquired after July 4th, 2025. That cap of 10 million has been raised to 15 million, right? So that's a pretty big enhancement. So now the rule is you can exclude 15 million or 10 times your basis, whichever is higher, right? And if you held it 5 years or longer, there's 100% exclusion. But they've also enhanced it by reducing some of the holding period requirements with these tiered exclusion. And what I mean by that is if you held it 3 years and not 5, you get a 50% exclusion. If you hold it 4 years, you get a 75% exclusion, right? And there's some on the 3 and 4 year holding periods, there's some AMT preference and as well as some nuance to calculating the tax on the excluded part of the gain. But we can probably get into how some of that works. Also, an enhancement is not only get the 15-year cap, the asset threshold, right, is moved from 50 million to 75 million, right? So before, if you had a qualifying trader business, C-Corp, originally issued C-Corp stock, right, valued at under 50 million before and after the transaction, now it's been raised to 75 million. So you get a 50% increase in the asset threshold or the valuation threshold, and you get a 50% increase to the $10 million exclusion. So it's a pretty good enhancement. It's a net. It's a great thing.
Well, I'm certainly understanding if your value is under 75 million, it might be where I would come in to talk about that. Really, though, in short, it's not so much a complete overhaul as you said. It's a addition, a bolt-on, an update, and it sounds like there's a lot of really good provisions, including some instead of just a cliff, there's some partial benefits that you can get at 3 and 4 years instead of just only at 5 years, and because it is a bolt-on, we should just push everybody who hasn't seen it already to watch the previous MaxValue episode talking about QSBS that you
Right.
and I did not too long ago. Once you're finished with this one, because all of those same bones of that one still apply today, and that one really goes into some of the details. But for today, why don't we dive into some of the details or an example of what you're talking about that might lead us to some more advanced planning or some things that we can do now that we couldn't do before.
Yeah. Okay. Well, let's go through a couple of just simple examples, right? So
yeah.
Let's say Sarah invests in a startup in 2025. with $70 million in gross assets, the startup, that is, which qualifies under the new $75 million threshold. She buys QSBS for $1 million and sells it after 4 years for $13 million, realizing a $12 million gain. So with that fact pattern, there's a 75% exclusion. So 9 million is excluded. And the non-excluded part of the gain, or 3 million, right, is not taxed at the capital gains rate. It's taxed at a special rate, which equates to about 31.8%. It's the 28%, which is the AMT rate, plus the 3.8% net investment tax. So that's how you get the 31.8%. But the 9 million is still excluded, right?
Right.
Also, there's a little bit of, since it's not the 5-year threshold, this would be a 4-year, right, holding period. There's a 7% add back on the excluded gain, right? So there's that. So it's an AMT preference add back, which will, if they're in AMT, will bump up their tax a little bit, but net, it's a home run.
Right. That makes sense. And, if, as compared to the previous iteration of 1202,
That's
she
right.
wouldn't have had any of that benefit, given
She wouldn't have had any of that benefit, right?
That fact pattern.
Okay. That's right. So in this fact pattern, there's a 4-year holding period. If it was a 3-year holding period, right, she would have 50% of the gain excluded, right? Whereas in the previous 4 years, 25% is excluded, but 75% is excluded, 25% is non-excluded under the 4 years. Under 3 years, 50% is excluded and 50% is non-excluded. So that 50% would be subject to the AMT preference and taxed at that higher rate. But net, the 3 or 4 year holding period wasn't even available before, right? So it's still a really good benefit.
Cool. And do you think these changes open up new strategies that weren't available before, besides the holding period?
I don't think it changes the strategy necessarily, but what it does do is it gives so for instance, the R&D, right? Part of the big beautiful bill is R&D is expensed, right? So if you have a startup under the old regime, that R&D had to be capitalized so it could bloat the balance sheet, right? So you get a little bit of relief from a gross asset test or the valuation test, because those R&D costs are now expensed, right? So there's a little bit of an additional benefit there, but really strategically speaking, the overall strategies don't change. They're just enhanced by the additional gain on the cap of 15 million, or they are enhanced by having access to a shorter exit holding period, 3 or 4 years. But at 5 years, there's 100% gain exclusion within the cap, and there's no AMT, right? And I could jump into an example was very similar to what we talked about on a prior podcast, if you'd like to do that. So Ben, you'll probably recall on our prior episode, we talked about, most startups, the founders will go to Delaware, start a C-Corp, right away. And, most of the time when you do that, you're really stuck with that $15 million benefit. That 15 million becomes your cap, because when you really start a business, you're putting in know-how, a nominal amount of cash, and maybe some other things. The point is you're going to have a very low basis, right? But maybe in the seed round or the pass the hat round, the pre-Series A round, you start as an LLC, right? So if you start as an LLC, right, and let's say you go, you achieve MVP status, you have a minimally viable product, right? And then you go out for that first round of funding, right? And as an example, let's say that a VC is going to come and for $20 million, they're going to get 1/3 of your company, right? So in that example, right, they're going to put in 20 million bucks, and either the individual LLC owner or the group that owns that LLC, they're going to contribute their LLC units, right? So if the VC is contributing 20 million, that means the LLC units contributed in exchange for that stock, right? That means they're worth 40 million, right? 1/3 of the company is worth 20, 2/3 is worth 40. So what you've done right there, total enterprise value in that example after the funding is 60 million, right? So that means for purposes of 1202, the fair market value of the property contributed in exchange for the C Corp stock is 40 million. So for 1202, that 40 million is your basis for calculating the 1202 exclusion. So you'd have 15 million or 10 times your basis of 40 million, or $400 million is your potential capital gain exclusion, right? So that's a pretty big benefit, just being thoughtful about how you come out of the gate, starting your company. In this instance, we said it's an LLC, right? Achieve minimally viable product status, and then go get that A round of funding, right? That example just created a potential $400 million capital gain exclusion.
Right. Absolutely. And now that your example illustrated it very well, now that the total value cap of the company has gone from 50 to 75, it's allowing for potentially a ton more of that. And even companies that have already issued quite a bit of stock, there may be, some window. What do you think about that? That having that some small window to be able to issue new shares under that $75 million cap?
Yeah, I mean, you said it right there. I mean, as long as that is original issuance from the company directly to the acquirer, and they're not acquiring it from another individual, right? If it meets that below $75 million threshold, all of that additional issuance is qualified shares. So that works.
Cool. That's great. All right. Hey, Gary, you know what? I think it's a pretty simple update. Really appreciate it. That's really valuable. But you know what? I realized actually just earlier today that we didn't, in our last episode, do a getting to know you segment like I've done on basically every other episode. Do you mind if we take a minute?
Sure.
Awesome. Because you're a cool guy and I want people to know you.
God bless you, Ben.
So tell me something that's not on your LinkedIn or website profile.
About me?
Yeah, well, I mean, I could be about anything, I suppose, but yeah, about you.
Yeah. Well, what's probably not on the website or on LinkedIn is I have a men's ministry, a private foundation called Second Man Group, and it's really focusing on men. It's a Christian ministry helping men recover the masculine heart that they had when, at the beginning of time, when God basically, when God first created them, he created them with a masculine heart. So it focuses on recapturing that masculine heart. And so it's helping men understand that masculine heart that God gave them, right? So so that's one pillar of it. A lot of people don't know that side of me, but I spend about 1/3 of my time in that ministry.
I know you're very, very, very dedicated to your faith, and I think it's super cool that you work on men being better men, and that's half the human race, isn't it? So that's really cool.
Yeah.
About your job, your profession, why is what you do rewarding to you?
You know what, Ben? That's a good question. I think number one, because I've been gifted with being able to identify the parts of the Internal Revenue Code, as you know, is it's 2 books about that thick, right? So but there's really only a small piece of it that is really dedicated to preserving and compounding capital for families and business owners and individuals. And for whatever reason, I'm just kind of a dorky geek when it comes to that kind of stuff. I'm good at it. And when the penny drops on the value that we provide, and you see the planning and all that come to fruition, of course I get a reward out of that. And so I guess the short answer is I'm pretty good at it. And there's really only, a small fraction of the code that applies to that, but I know it reflexively, right? It's not the whole 2 volumes that I know real well. It's that small piece that's really about preserving and compounding and getting the most out of the Internal Revenue Code, because the default settings of the Internal Revenue Code are not aligned with a business owner or a family's unique asset base, their values, or their legacy goals. You got to really understand how to dig that out and align that to what the client's trying to do. And I just enjoy doing that.
That makes, absolutely. The Internal Revenue Code is aligned to raise revenue for the government. That's kind of
right.
the whole point. And
that's right.
Other things that I'm sure philosophers and economists could argue about ad infinitum, but having subject matter mastery is truly rewarding. I agree with that for sure. All right.
And then they call it the unholy trinity: taxes, creditors, and predators, right? So we build a strategy around a client's goals and their unique asset base that mitigates those 3 risks. And everybody knows what taxes and creditors are. Predators are like, just an example of that would be like your children get married and you don't want 50% of their property going to a potential spouse if there's a divorce or a breakup in the marriage. So there's a way to title assets that protect the family, the family wealth from generation 1, 2 to 3. So we like to say that we help mitigate against the unholy trinity.
Got to be honest, I was a little worried where you were going with that for a second. So glad that worked out. All right. So the very last question. We're all trying to improve ourselves over time. One great way of doing that is with reading. What are you reading these days?
Ben, I just finished a book called God's Undertaker. It's by John Lennox. And he is a PhD mathematician and PhD scientist from Oxford. And the book in a nutshell is basically shining a light or making the case that theism is more aligned with science than atheism. It's a fascinating book covering all kinds of interesting things, from the cosmos to evolution, biology, quantum physics. It's very, very interesting. I just finished it on vacation. So God's Undertaker by John Lennox.
Huh. That's funny. It's not funny. That's interesting. The funny part about it actually is the book I just finished reading was The Demon Haunted World by Carl Sagan, which is kind of the if you will, the opposite take about that. Not that he's purely anti-religious. He's got space in there quite a bit for religion.
I've definitely heard that. I've heard that's a great book.
Absolutely.
I've actually heard of that.
Check it out.
Yeah.
Any case, but maybe I'll check out Lennox too.
There you go.
All right. Well, cool. Hey, Garry, thank you very much for joining. This was awesome. I appreciate it.
Awesome, Ben. Thanks for having me again. Really enjoyed it.
See you on the next episode, man. Thanks.
Yeah, you bet.
All right.